staying with us as we continue to stream. So tonight we got a few things we're going to talk about, maybe a couple. In particular, we have the economy. There's a few items that we want to discuss about what's going on and why, and the cycles that are occurring. And then we have a real life example of some stuff that's happening in the housing market. I currently did an investment opportunity. Dill, my man here, is also looking at some opportunities, either for personal or investing. So we're going to break down a couple different markets and kind of what's happening. And I'll give a real life example about a recent purchase that I did. So pause there for a quick second. Anything we need to tell the folks here?
I think so. That's a great little synopsis of what tonight's going to be. But thanks as always, guys, for coming by the stream. And we're excited. I think we're on episode 6 since our little reformat of the podcast. So if you're watching us on YouTube, please, we love to hear your thoughts in the description or in the comments. Like the video and sub. And if you're watching the stream right now and you haven't did any of those, please go sub to the YouTube page. Try to have the content on there for you guys. If you missed tonight, you can always watch it on YouTube. So put that on there for everyone. Throwback. Ooh, hurtsies. That's the greatest call of ever. That will nothing will ever beat that call.
As of yet, we're gonna have many more to come. I can guarantee you that. So it was a good call, high risk, high reward, as we talk about. But yeah, Hertz, that was a good one. I can appreciate that one, 100%. But yeah, as we're moving forward, also just a reminder, we stream every Saturday. So 7 p.m. we game, 8 p.m. we talk about Stock Talk, the Real Talk, sponsored by. Real Talk. That's a good one. We need that. And then we kind of game thereafter and continue talking stock. So as you can see, we split the screen, but this specific presentation, we're going to stick to one screen specifically because there's a lot of depth to this conversation and we need the full screen for this specific.
We do. Need all the space.
And then also have to remind folks, we are not financial advisors nor institutional investors. The content here posted on our online platforms, is for informational purposes only. So you need to do your due diligence. You need to make sure you know what you're doing when you're investing. Please take our information and make your own decisions based on what's happening. So we will dive right into it. The market cycles.
Yeah, so we want to start tonight just talking about market cycles because obviously, the market's been on a tear basically since COVID. And so we really want to dive into, what are market cycles, where we might be in the market cycle, and what we need to look out for. So Snake kind of brought it up, the first screen. This is kind of just the general characteristics of each market phase. So there's kind of like, 4 stages. So you have a recovery, you have the peak, the downturn, and the trough, which is kind of the bottoming. And then that cycle repeats over and over. And so kind of identify what each of those, we'll just read it off, but you can read it on here. So the A stage, you can kind of associate this with what happened during the COVID crash when we were recovering from the bottom of the COVID crash. Kind of. COVID's not a really true example of this, but it's for the context reasons we'll use it. So in the A recovery, consumer expectations rising. These are all things that happened during COVID. Consumer expectations rising, industrial production growing, interest rates. Interest rates did not rise during the recovery. I guess they did a little bit, or they went down. That's a nuanced one. Stock prices rise, we saw that, and GDP rise. So those are all things that we saw during COVID, and I think we're still seeing to some degree. The peak, so GDP starts peaking and employment starts peaking. So those are kind of 2 main characteristics of a peaking market. And then the downturn, consumer expectations fall, which we are starting to see a little bit of. GDP falling, we haven't seen that yet, and then unemployment still growing, or unemployment's growing. So we're uncertain about that unemployment part right now, but there are some red flags starting to show a little bit. And then on the trough, you have the yield curve inverting. We're not going to cover yield curve inversion tonight. That's a really deep talk that we can just talk about all night by itself. But GDP low or negative, and then consumer expectations low. So it's really interesting when we talk through those 4 phases, because I think right now we're seeing a mix of a lot of these, which is really interesting. So like GDP hasn't peaked yet, but the growth has slowed significantly. Unemployment hasn't peaked, but it's slowing drastically, and it's a lot of inconsistency from month to month. There are a lot of jobs, but not a lot of them hiring, so still unemployment's relatively high in that regard. We're seeing consumer expectations pretty low, but we're still seeing things go up. So we're in this really weird phase of the market, and we're trying to figure out where we're at. And so, if you go to the next slide, Nate. The next one shows um,
I fix it.
kind of the different industries and the correlation with the market cycles. So as you can kind of see in a bull market, or let's start from the bottom. So the market bottom, which is kind of the trough area. So finance, technology, and cyclicals typically perform. And then as we're coming into a bull market, which a lot of people say we're in right now, you see basic materials, industrials, and technology, which is, I would say, pretty close to what we're seeing right now.
Mm-hmm.
And then at around a market top, you start seeing basic materials, energy, and staples. And then bear market, energies, consumer staples, and healthcare. And then late bear markets, healthcare, utilities, and finance. And so the main thing to call out on this chart is the difference between stock market cycles and economic cycles. So the blue line is economic cycles. So the thing you have to realize about the stock market always um, acts before where the economy's. So the stock market is preparing us for where the economy is heading. So as you can see here, a bull market starts when we're in a full recession. So at the bottom of the recession, the market's already starting to go up, but we're seeing the economy still lag. And then as we start to see towards the end of the bull market, heading to we're starting to see early recovery. So when the market's at a peak, the stock market's at a peak, the economy's not at a peak yet. So this is really important to note because, on streams we often talk about how the economy's looking, and then we'll bring that into what the stock market's looking. So we really need to understand this dynamic of how these two important parts of the economy, because the stock market is part of it, the financial system, how these things work independently and how they flow together. And so this is really important. And I would say get this chart. I'll put the article that I got all these charts from, but you should have this on your tab or something if you're really keeping an eye on the markets. So this is something really important to keep an eye on. And so kind of thinking about how things have performed. Yeah, Nate.
So at what point are you looking at, I assume it's institutional investors and some of these big wigs that have money that start pouring into the market? I mean, are we looking at it as this bull market run's going? We're following those breadcrumbs to figure out where the sector rotation is going to go. And then obviously the economy's lagging a little behind that. But I mean, what's the indicators that you're looking at when you're following these sectors going
forward? So if you go to the next slide, I think what's really interesting there is, so the S&P 500 and the NASDAQ, which are the most popular indexes to follow, those don't ever really give you a true indicator of how the stock market's looking. And the main reason is because those are so weighted to FANG stocks. And FANG stocks, in a really strange way, are you can't put them into an industry because like companies like Google, they're structured in a way where it's really hard for those to have negative impact happen to those companies because they have a ton of cash. They don't really deal with inflation in a negative sense. They actually thrive in inflation. So it's a very strange name for some of these names. But when you actually break down sectors, this is where we can start analyzing, like, okay, what trends are we seeing on an industry level? So kind of in that last chart, what we saw was like, okay, when we see tech out, what is it? Let me go to it on my end real quick. But tech, industrials, and basic materials are basically during a bull market. And so when we look at here, like, what are we seeing on the chart? So obviously, I don't know if they even have the QQQ on here. Do you see
I don't.
tech? I see info tech, which is semi the same thing. So I mean, when you look at this, it's kind of hard to see, but the brown line is basically tech. So tech still looks in an uptrend. We're having a little bit of a pullback more recently, but it's still showing a decent uptrend. Materials, which is the purple, like, it's kind of gone sideways somewhat since June, but it hasn't turned over yet. And then the last thing is industrials. So where's the industrial ETF? Is the green line. So the green line, it's hard to see, but it's kind of close to that brown line. It's still going in an uptrend. It's starting to slow down a little bit recently, but that's because the market also went down the last 5 days. But we're still seeing those still uptrend. They haven't showed a rolling over yet. And so when we're looking at that market cycle, for me, as long as I see those things in an uptrend, it tells me we're still in a bull market. So it doesn't mean that things like energy, consumer staples, and basic materials can't perform, because that says those perform at a market top, but it doesn't mean they're not performing now. What we really want to see is tech to start to slow, and we want to see energy, consumer staples start to move up, and that will tell us, okay, maybe we're heading or we're at a market top. But when we look at the data, it doesn't really show we're at a market top, because when we look at energy, it popped back in June and it's come down. So that shows us if tech is still going up, but energy's come down, then we're still in a bull market. That wasn't the peak of energy yet, potentially. Or just for it's not a one-off scenario, let's look at consumer staples. So consumer staples is the pink line. The pink line, consumer staples, is all the way at the bottom. So consumer staples hasn't even performed yet. So that tells us we're not close to a market top yet. Like consumer staples, they start performing at a market top. And so that data is telling us, okay, we're not at a market top yet. As soon as we start seeing consumer staples start to accelerate, that's when we have to start considering us getting towards that market top. And so the data is telling us we're not at a market top yet. Um, the sectors of bull market are still showing progress, and kind of what Nate mentioned when we go to you can always look at what I like to do is look at institutional investing. So we always bring it up, especially on Sunday nights. If you don't tune in, always bring in institutional investing, and we still see a lot of money going into tech. Still way more buying than selling. That's for sure where most of institutional investing is still headed. And so, based on the data, we're still seeing a bull market. The data saying we're in a bull market hasn't turned over yet, and market top sectors have not drastically turned up. Energy, I think, is a one-off scenario because of COVID and a lot of chaos there. But when we look at the other sectors in market top, they still haven't performed relative to the rest of the market. And so, still looks like we're in a bull market. Things haven't changed. And so, looking at,
Yeah.
I'll post a site with this graph as well in Discord. But these are things you want to keep paying attention to over the next month, 2 months, 6 months, year. Figure out how these industries are performing against each other.
Yeah, and I think it's important to note, you alluded to it earlier, the S&P 500 index is heavily weighted by the top 10
Yeah.
companies. It's actually weighted 28.5% of the S&P 500 is weighted by the top 10 folks. So the FANG, Apple, Microsoft, Amazon, Facebook, Google, or Alphabet, both classes A and C at this point. You have Tesla, Nvidia, Berkshire Hathaway, and then JP Morgan. So those 10 alone have a 28.5% weight on the S&P 500. So unless you have them in your portfolio or you're following them heavily, and can discriminate those between the top 10 and the rest of the market in the S&P 500, to your point, it's kind of hard to parse that out without looking at the sectors also. So very good point.
Yep. And I think let me change the order of these slides real quick because I actually want to do this in a different order. But see if I change it on my end. But can you go to the three-point slide? So a couple of things that I've just noticed about the market is when we really look outside of FANG, a lot of the growth names and a lot of the growth have to go inside the tech. So a lot of growth has topped in late February, which is really interesting. So obviously the S&P is at all-time highs. Nasdaq's basically, at least of last week, at all-time highs. But we saw growth in smaller mid-cap names kind of peak in February. So it's really I'd say that the market's not kind of following a typical trajectory of a really big bull market. And so it's like, what's going on? Why is this happening? Obviously, energy has been kind of an isolated scenario, as we just talked about. Like, energy has performed really strongly, and typically we see that, perform well towards a market top. And now it's pulling back, but we still see tech going up. So obviously, some of those influences were on COVID and the economic shutdown, and then the reopening and supply being really low, inflation, stuff like that. And the third point, which is interesting, it's not as correlated to the stock, but we see the housing market seeming to cool a little bit. So prices have soared. So we're starting to see a lot of asset prices cool down across the board. And so it's like that really makes me think what's next and or why is this happening? And so there's like really two things that we've talked about it before, and it's really important to understand these points is the market really the market performs significantly or the market performs drastically to the upside when there's a lot of liquidity in the market. So liquidity is just cash to buy assets. Those assets go up in price, the stock market goes up, and the Fed has been buying mortgage-backed securities, bonds at such a high rate that people don't want to invest in those sectors. Like people aren't buying bonds because they're too expensive because the Fed has been buying them, and so all the money moves into the stock market. And so what the Fed has been saying is they're not going to start tapering anytime soon. Like they're not interested in it. There's been some talks lately from some people in the Fed of like we need to start considering it, but Jerome Powell, the head, he's like we're not tapering anytime soon, maybe later this year. And so that's something to know. As long as they're purchasing record numbers, asset prices will continue to go up. And that's going to be a big freeze. Is when do they start tapering? Because once the Fed starts tapering, some of the juice of the market is going to be pulled out. And so tapering doesn't mean the market's going to crash. It doesn't mean it's going to fall. It just means they're purchasing less. So they're not stopping purchasing. They're just purchasing less. And so what that means is we potentially will have less volatility to the upside at least. Right now, obviously, I think this year the S&P's up like 22% or something stupid like that, or maybe a little bit less than that, but around that mark. It's because there's so much liquidity. And so when that liquidity starts to dry up a little bit, we're going to see less violent moves to the upside. Doesn't mean the market's going to stop moving up, but it means it's going to be less violent to the upside. And so that's one thing I'm keeping my eye on is Fed tapering. The second thing is interest rates. So the Fed has said that they're not expecting to raise interest rates until late end 2022 at the earliest, mid 2023 is what they've been projecting. And so when you think about how interest rates have an impact on asset prices is when you have those interest rates, one, people buy homes because it's really cheap to borrow money, as well as companies borrow money. So small growth tech companies, they borrow money, it accelerates their growth, which grows their revenue, which when people see their balance sheets show larger revenue, people buy their stock prices go up. And so everything inflates because interest rates are really low. And so asset buying from the Fed as well as low interest rates are like the double duo that's basically caused asset prices to explode over the last year and a half to 2 years, basically since COVID started.
So you have 80
And
billion a month
yeah,
of treasury securities being purchased, right? And then 40
yeah,
billion of mortgage-backed securities. That's
which is like
essentially
record
holding the
numbers.
economy together at this current time.
Yep.
So the tapering is very interesting. I'm curious to see what happens at the end of the day. Ultimately, how this affects the economy. We've talked about it a couple different ways. Is it ultimately just is it an impending thing that's going to happen? That's going to transpire at some point. We're just prolonging it. And to what degree? So yeah, I'm curious to see.
Yeah, I mean, you kind of get to my next point is like really when we look at the economy, like we're starting to see a lot of data come out, and we're going to talk about some more next week about CPI and PPI and such, but we're starting to have a lot of data come out that's not showing that the economy is doing as great as asset prices have been expressing by the price increases. And so, really, when you look at it, low interest rates, lowest of all times. We've never been this low interest rates before. And Fed spending and printing money like we've never seen it before has really artificially elongated the drastic rise in asset prices. So we've never seen asset prices recover so quickly. And it's really mostly due to these two scenarios. There's other impacts, but these are the main ones. Um, but we're starting to see a lot of data that's starting to put pressure on the Fed to make decisions. So we've talked about in the past is like CPI numbers are the highest they've been the last 20 years. PPI numbers, I think, in the last 40 years. And so basically this means is prices are getting really high. And when you have low interest rates, demand keeps up. So people just keep purchasing and purchasing and purchasing. which makes inflation go higher, which means prices go higher. And it's just this kind of effect that mean prices go higher and higher. And that's why we've seen housing prices go like crazy. And we're seeing consumer goods prices starting to increase. And it's a lot of these factors. So we'll talk about it next week because a lot of important news has come out last week about PPI. And next Friday, I think CPI numbers come out. So we'll get a little bit more info if those keep rising up. But if we keep seeing those go up, the Fed is going to have to taper and raise interest rates sooner than they're expected. And we really need to keep an eye on those. It's because all the data we just presented is those are the things that are really holding up the market, especially the tech. And so the S&P highly weighted towards tech, obviously NASDAQ, those things really hold the markets up. And when people see those doing well, they buy other assets because it's like, oh, the market's doing really well. I'm just going to buy something because it will also do well. And so these are things we really want to keep an eye on. I just have one last slide, um, and we'll probably cover this more in the future too. Is it still there, Nate? I know I was
Yeah,
moving it
it
around a
did. Yeah,
little
it
bit.
didn't update, but we're good.
Oh, okay. And it's just like, what do you do when the market starts to slow or starts to turn around? And it's like, how do you protect your assets? So there's just like 3 steps, and we'll talk about it more in the future too. But when we start seeing the market start to top, you really need to reduce your exposure. So, um, and it's really kind of the market cycle. So when we see tech start to underperform, we want to push our money into consumer staples, kind of those things that don't aren't impacted by inflation and other things and market downturns as much. Consumer staples are like your Walmarts, your Targets, your grocery stores, your consumer like brands like what's the mac and cheese people, but like
Kraft.
Kraft, like those kind of companies. Second thing is increase your cash holdings. Because oftentimes when the market goes down, interest rates are going up. Um, and with interest rates, sometimes the dollar goes up. So your money kind of appreciates a little bit. And then last thing is like you start looking for safer investments like bonds, short-term income, things like that. Because those are going to start how expensive they are will start to come down and they'll become more attractive investments. Most people who are watching this are young. You really don't need that much exposure to bonds, if any. But these are 3 things that, and when we start seeing the market turnover, we'll kind of bring these topics back up about kind of how our investments are switching. And they and I are even starting to switch our investments a little bit. We're starting to look into more of the consumer staples, things where maybe more value focused compared to growth. But those are just a couple things I wanted to cover. I know it's some really big topics, but I don't know if there's anybody in the chat. I know we have less people tonight, but does anybody in the chat have questions on those topics? If not now, if you're watching YouTube later, please put a comment or in the Discord. I'll probably post this tomorrow, the whole podcast. So please ask me questions later on as well. But this is really important to keep an eye on. Overly stating, watch the Fed spending, watch interest rates. That will tell us a lot about where the economy is heading, or already heading. So, yep, that's all I
Absolutely.
have, Nate, on that topic. And
Beautiful.
I'm excited
Speaking
about
of
the next
interest
topic as
rates,
well. Yeah,
right?
we can
And speaking of
definitely, yeah,
interest rates, this is kind of balancing your portfolio. One of the components that I absolutely love
yeah,
is I've actually pulled money out of the market as I reaped what I sowed, if you will, and purchased another asset that I'll talk about here in a little bit. And I know you're looking at doing something similar. And as we're moving through this process, please do comment. Very curious to hear people's perspectives on this as we're going through this in real time, or I am in particular. But I know Dylan's been doing a lot of homework and trying to figure out also what are the other markets that are maybe untapped. But as interest rates might start increasing, we might see some pullback from the market. We've seen some of the housing start to cool down a little bit, as was being alluded to. And I just kind of wanted to talk briefly about some of the market trends of what's happening, how 2008 compares to 2021 and the housing market crash and so forth. And so back in 2008, we know that the market collapsed predominantly because of subprime lending. And the fact, I'll talk about it here in the next slide, the interest rates were just so excruciatingly high that people could not continue supporting the current payments that they had. And I'll give a couple examples of what those payments are, and you'll see why. So subprime was a huge component to that. And then there were some refis, as we're witnessing now too with HELOCs in 2021, as well as refis. People were buying boats and other luxury items that they really did not need, which heated the market up in a couple different scenarios. And so comparing 2008 to 2021, similar but different scenarios. I think with the inflation going, CPI, the Consumer Price Index, the PPI as well, figuring that portion out and the tapering, Jay Powell or Jerome Powell, and some of the other folks that are trying to figure out how do we keep the economy afloat, but also bearing in mind that it got pretty heated here recently, and part of that's because of the low interest rates. So as they start creeping up, it's definitely something I'm looking at. I know Dylan's looking at of where do we start looking at putting some of our assets, or quite frankly, where do we start moving some of our portfolios around to better reflect the current moment of the market. And so inflation and price increases have gone exponentially high in 2021. The bottom map graph that you see here, you see all the appreciation that's been happening year over year. California's 70K. Texas is actually, I think, probably more than 19K at this point. At least the average, specifically in Austin and Dallas and some other parts, the metro areas. But you look at that map and everybody's appreciated almost for the most part, and in double digits. I mean, these are not like $10,000. This is 50,000, like 20,000. So as people start gaining equity in their asset, they're going to start pulling that and putting it into something else. And then we have the quantitative easing and forbearance that you'll see here. The foreclosure activity has tapered down a bit, but part of that's because the annual increase of the time that it takes for the foreclosure event to happen has increased from 600 days to 900 days in the last year. So you're going to see that kind of taper down. It may or may not pick up. So I'm very curious to see how the market responds to that, but more in particular, how homeowners respond to that as to whether they can sustain the current payments that they have. So part of that goes into the 30-year mortgage charts here. And 30-year, there's 15-year, there's ARMs. We could talk about that another day. But we're looking at the traditional 30-year mortgage loan rates here. And they peaked back in the 80s. That was hyperinflation. Many things were happening back in the day. But I really want to look forward during 2007, 2009, and up to 2021. Here's a better chart for you because it has actual numerical data here. But back in 2008, interest rates were 6.03%. Insanely high. And so when you look at that versus now in 2019 and 2021, 3.94 in 2019, and currently we're at average of 2.65 for a 30-year fixed rate mortgage, which is substantially much lower than what it was in 2008. So when you're looking at subprime loans, maybe the banks weren't looking at all the paperwork that they needed, and then they were selling these mortgage-backed securities, or these junk bonds, if you will, or junk securities off in hopes that they can gain from the national and international market. And it threw us in a bad moment for the following 4 or 5 plus years, in which I bought my first home, quite frankly, in 2012. And I would have did it again. It was a perfect time. Opportunity came up, bought a foreclosure. Sucks to be the person on the other side, 100%. Yeah. And I feel for them. But when the market reacts, people like myself respond. And so as we're looking at that, in 2008, just looking at that, the monthly cost, $200,000 mortgage was $1,200 a month. Like, that's insane right now. Versus $806 for the same value of the home at 2.65%. So the discrepancy of $400, if you can think about that, right? Theoretically, 30% of your paycheck should go to rent or mortgage, your housing situation. I mean, how many people have disposable income of $1,200 a month to put into their rent or housing? And so I wanted to pull up a couple things, and then I'll pick your brain here, Dale, because you're going through a similar event right now. Is at what point do you rent versus buy, or buy versus rent? And this is a very interesting moment for a lot of us right now. And so the median price, and I'm going to pull San Jose or the Bay Area because this is where I live in the Bay. And it's recent that now we're hitting a moment where the median price, 1-bedroom house, is about $549,000. The average in the Bay is actually 1.1 million for the average home. So yeah, so 2,400. That's if you have 20% down. That's $100K that you have to be able to put down. $110K to be more accurate. A down payment of $110K. Who has that kind of cash?
Nobody.
Not me. But you're looking at 3.5% if you get the FHA or the government-backed loans. Those opportunities do arise, but then your monthly payment increases. So you're kind of stuck in the situation that we've talked about before. It's like inverse correlation of interest rates and housing prices, where instead of the interest rates being high and theoretically the housing prices being low, now we're at the reverse stage, the inverse, where interest rates are low, but now housing prices are so high, you're actually outbidded by virtue of the housing market being so expensive right now. And so just kind of going through it, this area, San Jose, Sunnyvale, Santa Clara, we're the second most expensive to rent in the country. So then the question goes, well, should I just buy, right? So because you're looking at rent where for a one bedroom studio apartment, it's 2,400 versus if you buy, it's 2,400. But you need that down payment or that upfront cash to be able to put down to be able to purchase that. So it's this weird conundrum that we're in right now where if you don't have the assets or the dollars to be able to put down to purchase, you can't really buy, but then you're paying the same amount that if you're renting. So very curious to hear your perspective on this deal because you're in an area of Texas that it's happening as well. I mean, what do you do in these situations? Very
Yeah, I
curious
mean
to
the
hear.
Bay Area is such a weird, like, these kind of areas are a weird one-off because home prices are so much higher than everywhere else in the country for the most part, besides like New York and a couple other areas where you have to pay like $1 million for a
Mm-hmm.
or $1 million for a three-bedroom home. But like, I'll give Austin as an example. So if you don't know much about Austin, Austin has evolved a lot just over the last 3 or 4 years, specifically from the migration of states from like a lot of Californians moving here, as I did myself. And what that's happened is it's caused not only home prices but rent prices to kind of increase in value very quickly. And so it's a different scenario than San Jose because when I think about renting versus buying, I'm thinking about what's the net difference I'm paying between those two things, like Nate mentioned. So for Austin specifically, so my wife and I are typically going through a process right now of like, should we buy a home? So some areas of Austin I think are not the same home prices, but similar. An example where in this area we can rent a home for 2,400, but to buy a home our mortgage would be 34, 35, 36. But there's other
Mm-hmm.
areas where we can buy a home. Like for example, our rent right now due to like inflation and home price going up, like our rent is probably going to get pushed up next year. And if
Mm.
we buy a home, say 5 or 6 miles away in a more an upcoming area, our rent will be the same as our mortgage payment of buying that home will now be the same as our rent would be. Um, yeah, it's definitely buying right now is hard.
Yeah.
But yeah, so in Austin, it's a place where, oh, there's areas of up and coming. There's still decently nice areas where you can buy a home and it's pretty close to what you'd pay in rent. So that's kind of the back and forth that I go in right now is
Yeah.
that's what I weigh, kind of like Nate saying, is my rent close to my mortgage? And do I think we're in a market where when I buy the home, it can appreciate in value? Because that's the other factor of like, buying a home, there's other costs associated. So then it's like, okay, if I'm paying, say, $100 or more for my mortgage, but I'm
Right.
also expecting that property to increase in value 20, 30% over the next 5 years, then it's more gain than risk at that point. So that's kind of the predicament that I think I'm currently in,
Yeah.
which is what are those decisions do I make?
Yeah. And as Jake notes, I mean, your money's going towards the asset or building your wealth, if you will, as you're moving forward through your journey of owning home and investing. So, a very important point that you did bring up. I mean, it's yeah, what's the discrepancy or the net gain or loss renting versus buying when we're talking fiscal or money that is going into it, but then also the outlook, like moving forward. Is there an opportunity for it to appreciate? Maybe you rent it out, maybe you sell it and get that net gain. In certain circumstances, you don't have to pay the capital gains tax on selling your home. There's stipulations to that. But depending on the scenario, or do you buy a duplex or a triplex and live in one unit and then be able to list the profit from renting the space, which can actually help you buy a unit. So there's a lot of plays there, definitely. But as we're talking about the market, there's one big thing, and this is whether you're owning for yourself or an investment property. These are definitely items that I look at personally, and I know you do too. And there's many folks who talk about this, very brilliant investors. And so gleaning from that, but also from my personal experiences, right? I'm looking at the where, the what, and the how. So where am I looking predominantly geographically and or on a micro level, like what neighborhood? and why, and then what kind of unit am I looking for, and then how am I going to purchase or finance this investment as we're moving forward. And so one of the big things I know you're very fond of, Dill, is looking at growing markets, getting in early,
Yeah.
as am I. Urban versus suburban, really like looking outside of Austin, for example, 10, 20, 30 miles outside of, close enough to the town center that, or the downtown, that people can commute. But we're also seeing, in the Bay Area, the commute times are over an hour to go, 30 miles. Forget LA. Like, that's a completely separate scenario. But there's definitely opportunities for, depending on the segment or the market that you're looking at. And then looking, I compare the current prices versus historical. For example, we're seeing a cool down, right? Or a pullback, if you want to talk in vernacular of stocks. Like, how do we start looking and analyzing at this, of saying, okay, have we hit the top yet? It's kind of tapering a little bit. I think we're going to see some decreases. And then where you locate or where you purchase as well, there's going to be certain insurance requirements. You need flood insurance. Like Hurricane Katrina, like after that devastating thing happened, yet another hurricane. I know in like Sacramento, we had a 100-year flood, a mandatory insurance that we had to purchase because we didn't keep up with the 100-year flood plan. And so FEMA came in. It was a whole thing, but we were required to increase our insurance by virtue of that. And that was out of our hands. Like, we couldn't control
Mm-hmm.
that. And then there's the taxes, the property taxes, or any of the other taxes that go on your tax roll, whether it's schools, Melrose, which is a separate tax for public amenities and maintenance, apart from libraries, all that kind of stuff, and then the county, what they collect for you owning a piece of land in their jurisdiction. And then there's state and local policies that I definitely look at, that I think get overlooked periodically. It's just not talked about because it's probably not a fun thing, or it's a bit
Not
wonky to talk
sexy.
about.
Yeah.
Exactly. I was going to say that, and I was like, I don't know. But, like Prop 13 is a good one in California, and I know Michigan has it as well, where they cap the property taxes at 2% year over year. So they can't increase. And, and it's predominantly because you don't want to get surprised by virtue of being a homeowner. You don't want an increase, or if you're renting the property owner is going to pass on the cost to the renter anyway, because you have to cover that in some form or fashion. So looking at all of that and just the where do you want to locate? And there's many, many things to understand. And that's really the basis of, okay, also what type of unit or units am I looking for? Is it single family? Is it a multi-duplex, triplex, or is it apartments, like 20 plus units? Maybe I want to look at commercial, like Jake was talking about. Maybe I don't want residential because I don't want to have to deal with people and the ongoing maintenance that goes into that. And so maybe I just want some storage units that I could purchase and do. Or maybe I want to get a little down and dirty, do a rehab, either yourself, contractor, or a turnkey. We were talking about this a little bit ago on the other stream, of people are willing to pay a premium just to have the house done. And that's where you're seeing
Yeah.
a lot of people paying over asking price, is they just want it, and then emotions set in. And so I'm very fond of removing emotions from purchasing. Money doesn't have emotion. So for me, it's very much looking at where's the opportunity count most. And I'll talk about cap rates and some other things with a purchase I just recently did. But there's got to be certain benchmarks that have to be hit for it to make it to fundamentally work in your favor. And then how are you going to finance this? And so friends and family, that's kind of the easy go to if you have an uncle that has money, or
Mm.
your cousin's a drug lord. I'm kidding, but whatever it may be, you need the funding. And so bank loans, you got the conventional loans. There's many different ways, construction loans, etc. HELOCs, refi. If you have a unit that you already own, you can pull some equity out and use that as a purchase opportunity. Hard money, higher interest rates. That's kind of non-conventional bank money. And then if you're really into it and development and so forth, there's venture capital. There's opportunity zones, for example, that I think they're expiring here fairly soon. But there's certain cities that had this opportunity for your folks to take advantage of the tax situation for capital gains that could be invested into other development or investment opportunities. So, did you what are you thinking, Dill? When it comes down to it, you've kind of have a market, the units that you're looking for. How do you plan to finance? What do you think about the game plan as you're envisioning your ideal situation to make a move?
Yeah, I mean it's so situational, but I think like I'll kind of go through the where, what, and how. So in my example, like living in Austin, I'm looking for area. One, I'm looking for homes and communities that maybe need a little bit of love, and I'm willing to put a little sweat equity into the home
Mm-hmm.
of, doing DIY type things. So that's one thing I'm looking for in terms of
Nice.
this could be either for a rental property or yourself, is
Yeah.
looking for homes that are undervalued in a neighborhood because people are lazy or they want to buy something turnkey and don't want to put the work in. So that's one thing that I look at. Second thing I look at for the where is what's happening around that neighborhood or that area.
Mm.
So, for example, I went looked at a home today, and I know this area of Austin is developing because they just built a soccer stadium a mile away. They're building out like another downtown 2.0. And so I know this area
Mm.
over time is going to develop and grow. Where there is free land, they're building new homes on it, and that, that obviously goes and appreciates the value of the homes around it. And so there's all these little, those are the two main things that I think
Mm.
are really easy to look at and do a little research on the where. On the what, I think it just depends on your situation. Nate mentioned it.
Yeah.
If you really, I think one of the greatest situations, if the numbers make sense, is buying a multifamily home and living in half of it. So that's a great way to find somewhere to live for yourself and potentially pay less rent than you would by renting or buying a home on its own. And then you can still potentially make some money on the side by having the second unit rented out or the duplex. So I think that's a real big what if you're willing to go down that route and you're in a market that makes sense. Personally, in Austin, I'm not looking at that because prices have appreciated so much. It's really hard to find a multifamily home that makes sense to live in currently. Um, but yeah, single family is obviously a really easy. They're typically lower price, so you don't have to put as much down. XYZ, and then the how. I mean, for me, one thing is I think when it comes to buying your home yourself, if you have decent credit, you don't have to put 20% down on a house.
Mm-hmm.
Um, a lot of people think like there's this misconception. People are like, "Oh, I hear you have to put 20% down, so you think you have to save up 50K or 100K, whatever it might be." Like there's opportunities depending on your credit where you can pay as low as 3% on a first time home buying, or you can pay 7% down or 5% down, 10% down. There's options, and if the numbers make sense, then that's a really great way where you don't have to save as much in order to purchase a home and build something that you think is going to appreciate in value. Um, I mean, I think some of these options only make sense like a free finance, like if you already have another property. But yeah, I think bank loans are really easy, especially I would say in our current market where we have all-time low interest rates. Like I don't think we're going to be here much longer. I think 2.8 was the lowest on the 30-year mortgage, and I think we're not going to go below that. We're starting to slowly trend up, and so now's a great time to buy a home if it makes sense. Don't buy a
Mm-hmm.
home just cuz, but if all these other factors make sense, the where and the what's, then a home loan, a bank loan works well because mortgage rates are so low. I think I got pre-approved for a 2.95, which is
Nice.
pretty low. And then I think Nate on your property, it was a smaller price, so your loan or your interest was a little bit higher, but it was like low fours, right? Or high threes.
Yeah, it was high. It was actually 4.75.
Okay, high fours. That was
Yeah, high
probably because your
fours.
property was so low in value, right?
Yeah, and it was a smaller bank. I mean, we can get a little into that, but yeah, definitely. We caught into the 20% idea too. Okay, probably.
Yeah. Yeah, the PMI. Yep. I mean,
Yeah,
that's another
I was going to talk about
20% down. If
that.
you don't put 20% down, you have a PMI loan. You have that PMI loan until you pay off 20%. And I believe on first time of the FHA loan, I think the PMI stays around longer than when you pay the
It's
20%
up
off.
until you
So
get to the 20% mark. So if you owe
yeah,
100 grand
there's
on the
some.
house, you put
Yeah.
3.5 down until you reach the 20,000 mark,
Yep.
you're going to have it. I just recently got mine off of my first house, actually. I finally hit the 20% mark, and part of that on my loan, the original loan, right? Not the equity on the house. But yeah, the
Yeah,
20%
that's
component's
tricky. Yeah.
important.
It does take a few years because you're paying off a lot of interest. But
Exactly.
to start off, because that's how they get you, pay all the interest off first. But yeah, those are a couple of my thoughts on what you're saying. I think those are the easiest place to start.
Yeah,
Um,
yeah,
and if you,
and
like you said, if you got a rich uncle, then you don't got to maybe pay the bank that
yeah,
interest
get
maybe
a
as
shark
much or
loan from your
something.
uncle. There you go.
Yeah, there you go.
But the hard money, that's
The
where
hard
that's at.
money.
But also GI Bill, I'd
That's
be remiss
true.
if I didn't mention that. That's 0% down, right? There's
Yeah.
by virtue of being a veteran, so there's options out there. You just have to know. I think, according obviously to what probably Rama's saying in chat, you just have to. Some of the information is ubiquitous. Some of it's a bit ambiguous, just because we don't know what we don't know, and then we kind of learn and live
And
as
I
we go
think one
through
of
it.
the biggest missed opportunities with properties, at least if you're able to live in a part of it or you're buying a home in the market you live, is rehab. Like if you're willing to get a little down and dirty, um, the a high percentage of the cost to do something is paying someone to do it.
Yeah,
Like I was looking up some numbers because I'm looking at a home that needs a little bit of work. And so when I was looking at the numbers, it was like to pay someone to do a bathroom can be 20K. Doing it yourself can be 10K. That's cutting off 10K off your costs. Doing a floor yourself versus paying somebody, you can, again, about 50% is going to those fees of having someone do it. And so I think people really often overlook rehab, a little bit of rehab work. I think Nate's going to get into it right here, but obviously, like bigger things that you can't do yourself, like
yeah,
roofs, windows you can't really do yourself. You can, but that's a little more hard, a little more technical. Pipes, electricity. Those are things that you can't really do yourself, and it's important to keep track on those. But I think you're kind of segueing into that, Nate. So I'll let you take over.
yeah. No, it's good, and yeah, thank you for leading into that, because that is actually an important component. Because the house that I purchased is actually in Detroit. It's one of these homes here, in front of us, and I'm not physically there. I don't have any ambition to fly out there right now and do the labor myself. I have a daytime job. I'm hustling, grinding, and then also trying to make a deal happen. And so I'll go through some of the items that I look at when I'm looking at this house, and once again, gleaning from a lot of the experience from all the YouTubers and all the information. Yep, YouTube, Jake.
Yep,
Just
YouTube, the best place, man.
grabbing all
All
that
you need.
information and conglomerating it into one kind of shoebox, if you will, in this presentation. It's like there's many things to check off, but in the broad scheme of things, this is what I'm looking at when I'm looking at an investment. So, like this middle unit here, um, uh, spoiler alert, that's the one I bought, the one in the middle. So, looking top down, I've learned this from a couple different people, being that this is my first property that I've never lived at, or um, I, I,
Let's
I
see.
I haven't even seen this property in person. Like, that's how sold I am on this opportunity, and I'll tell you why in a few minutes. We'll talk about kind of the economics of this, but the roof. Obviously, I think everybody knows this. It's like the basics, the ubiquity of this of the vernacular here of roof, being, is it 10 to 20 years old or less, right? I mean, I'm really looking at not wanting to replace a roof that's 10, 15K
Yeah,
easily off the top that you'd have to pay. So I'm like, crap, I don't I don't want to put that into my to the cost
it's a
of doing
big
this.
chunk. Yeah.
Gutters is another thing. I'll get into the prices of everything
I
that I
looked it up
spent here.
today. Gutters are freaking expensive. I just looked it
Yeah,
up today because the house we looked at didn't have any gutters on it for some reason.
and
I was
there's
like, I'm so curious
massive
how much it
damage
costs.
that could come from that. Yeah.
It's like so
So
expensive.
it is, and the type of gutter and all that kind of stuff. Apart from, but like this didn't have any gutters, right? And so now you have to worry about when I purchase it. So now I got to worry about, okay, if it rains, which it's Detroit, weather is not very favorable in this regard. But if it rains, what does that do to the soil? Is there going to be dry rot damage? Where's the
Yeah.
runoff when it comes to this? So gutters are important. The attic, is there any damage? Is there any concerns about structural items? Windows, do they need to be replaced? So specifically in Detroit, these are homes that were built back in the 20s, 30s, and so a lot of them have paint toxins that need to be removed, which requires a permit to be pulled, which is additional costs. And so you have to bear this in mind. Do I need to replace the windows? If not, please, cross your fingers and say no if it's one of these older
Yeah.
units. But I mean, the windows alone to replace those are
A
hundreds of dollars,
lot.
$500 to $1,000 depending on the unit. And so, and that's multiplied by 1, 2, 3, 4, 5, 6, how many of a rooms you need. So can they be sealed? Can they be? Do they need to be replaced? Whatever it may be. The floor, the ceiling, is there dry rot? Any other damage? As you can see here on the bottom left, this is one of the photos on the inside of the unit. I'll flip through some pictures here in a little bit. Inside, there's some ceiling damage or some damage in the bathroom. It's all pretty much cosmetic for the most part, but I'll dive into that later. The basement crawl space, is there any concerns? Once again, gutters, if there's a basement, is there a risk for flood in the basement by virtue of not having gutters and runoff, proper runoff, and so forth? So that's important. And then lastly, and probably the most costly, quite frankly, is dry and wet utilities. So any pipes that lead into the house, the mains out in the street that connect, and then internally, the electric grid, if you will, inside your house, but making sure that that's all fine and dandy. And this is kind of like a view. So when I go and look at the it makes sense for me to even consider looking at any further. Because if not, I'm walking away from this like, nope, it's well over my budget of 10, 20K or whatever it is. And so briefly going through my timeline, and this is a very recent purchase. So
real quick, Nate, I'm gonna bring something up. Well, I think when it comes to these like inspections and things, and Nate's gonna get into it, I think one thing I'm gonna bring up is a good real estate agent is super crucial. And I'm going through this process as I had 2 real estate agents. One just kind of happened quickly. The other guy, met him at an open house. And let me tell you, one guy sucked. The other guy was amazing. Because it's just how they handle themselves. Like, oh, we're going to do this and this. If you put an offer in, these are things we need to pay attention to. It's like running through all the steps, because when you're buying a home, Nate's going to get to the pre-inspection, just making sure what's wrong, what's not wrong. Especially like Nate, he's not in Detroit, so he needs someone he can really rely on to be able to help facilitate some of those steps before he purchases the property. And it has to do a lot with what Nate's here: roof, and then that's an inspection, windows, all these things can be a part of the inspection. And so having a real estate agent that is legit and knows what they're doing is super crucial.
100%. 100%. So started in June, and all of this actually started before June. I made the offer in June, but prior to that, I mean, this is 8 months to maybe a year in the making, like waiting for the right property, but having my assets ready to make the move. So, money in the stock market, letting it do what it does. And then I ended up pulling some of that for escrow, like immediately when I knew that I found a property, for example. So that just giving you kind of how my brain works on this. And so pulling that for escrow, knowing that I wanted this property, the property I really, 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 really wanted prior to this one had 26 offers on it, and I lost. I mean, cash, it was a perfect property. It was a quick fix. Not a whole lot needed to be done. Cash flow was there. Tenants were there. Long-term, like everything you would imaginably want. 26 offers. I think everybody saw that, and that was low-hanging fruit. So crazy. So, but I've been on the hunt for like almost a year prior to this actual opportunity, and waiting for the right time to strike, making sure that the numbers work, etc. And I have my own spreadsheet that I'll pull up sometime. But made the offer in June. I saw it 2 weeks prior, and I did my due diligence, ran the numbers, did a couple other things, and put an offer in. Working with the broker out there, never met the guy. We hit it off very quickly, and Dylan and I have talked about this recently by virtue of all the work that we're doing around this asset development, if you will, of do I jive with this broker or agent? And so I had a couple different people. I had like 3 different brokers that I was working with, just to kind of fill them out. And this dude hit it out of the park right off the bat. He had all the right answers. So, prior offer that was in, he pulled that information out and was like, oh, they pulled the offer because XYZ. Beautiful. Like, took it, ran with it, and immediately was like, when can we do an inspection? He's like, I got a guy. Perfect. Go. So while we were doing the inspection, he also said, if the deal goes through, do you have a property management team? I was like, no, I don't. I don't live in Detroit, etc. He's like, all right, I think I have somebody for you. So I said, okay, talk to the property manager. I asked questions. Person had all the answers that I needed. I was like, beautiful. Okay, good to go. So inspection went through. A couple things came back, nothing too drastic. And I said, all right, let's do this. Let's finish it off. So offer was accepted in July. Immediately got the property manager involved. That took a little bit of work, and they typically take 8 to 10% off the top of the gross receivable. So if rent's $1,000, they're taking 8 to 10% off 1,000. And so that's coming right off the top. That doesn't, they're not taking it off of $800 after expenses. So they're taking it straight from the tenant. So immediately after that, I was like, okay, we need a contractor. Once again, my guy hooked me up. I've been very, very pleased with the response time and everything. And the other thing, the flip side of that is I plan to do more investment out there if this goes according to plan, specifically with this person. So he has a guy. I said, okay, cool. When can you do the rehab work? I'll get him out there in a week. I was like, perfect. He sent me the bill. I'll kind of go over the bill here in a minute. And while all that's happening, my loan's done, and first payment's in September, which was on the first May payment. Meanwhile, I have one tenant's in there in this duplex. There's a vacancy in the other unit. But in the meantime, this is kind of the flow of all the things kind of working simultaneously. And so going into size 2 font here, into what needed to be fixed, if you will. And sorry if our heads block some of this stuff. But the gutters on the property is $2,200. This includes labor, by the way. So it's $2,200 to install new gutters. If you look at some of the smoke alarms, there's certain standards that have to be met in Detroit, and this is once again part of the local or state policies that you need to pay attention to as you're looking at investing, whether it's for you or as an investment property. But new countertops, $3,800 right off the top. New toilet, $300. So like all this random stuff, it obviously adds up, and the total ends up being about $13K. And I just put the first installment down to the contractor a couple weeks ago. So contractor's working on it. Everything's good so far. But you'll notice I needed to replace so many flippin' smoke detectors, some other things. He sent me all the photos, and he's like, you should probably really do your due diligence here, because in Detroit they just launched a new program that the city is doing that's going to be kind of like a code enforcement on the housing units for rental properties. So if you're not up to snuff on this stuff, they're going to ding you. You should just take care of it now. I was like, okay, fine, just do it, get it out of the way. So this is my full list right in front of you all. Paint, bed, like all the random stuff. I'm not physically there to do this work, but I did fix up my other property because I had a really horrible tenant that I will digress from talking about for the time being. But I saved a lot of money. I ended up going to small claims court, and in the state of Washington, the max is $5K. So you bet your booty I went for the $5K because it exceeded.
Hell yeah.
So anyway, yeah, total ended up being it's about $13,000, specifically on just a lot of the cosmetic stuff. So if anybody has questions, please keep me posted. And I know probably you just mentioned something, so there's going to pay most of the closing costs to cover that repair. Very important point that I was going to bring up here in a little bit, and part of the closing costs. Do ask for seller concessions whenever you're making a purchase where you can. So in Detroit, you can only ask for up to 2.5% of the price that the home sells for. So that equated to roughly $2,000 that I can ask in repairs to be requested. So Detroit, 2 units duplex. I'm going to run through this and deal, chime in, man, wherever. So this purchase price is with $130K, 25% down because it's an investment property, and that's what the bank was requesting that I do it. And it was a small bank. It's not a conventional, Wells Fargo or whatever. Funny story on my first loan, though, that I will get into at some point. I went with Wells Fargo. They declined me for my first house. I ended up going to a smaller loan firm. They gave me the loan to buy the house, and then they went back and sold it to Wells Fargo, which is kind of ironic. Yeah, whatever.
So Nate, real quick,
yeah,
why'd you go to a smaller,
quicker
bank quicker?
Yeah,
is it because the loan was smaller too? Do sometimes bigger banks or institutions not want to do smaller loans?
Yeah, so typically, very good point. So typically, the banks nowadays, they used to be able to do loans under 100K. But at this point, a lot of the banks, it is insulting probably, a lot of the banks are gearing away from the 100K loans because the market is so hot, but also the risk involved in that. It's not worth it for them to process the loan and package it and sell it how they would normally. So a lot of them do not do loans under 100K. For my properties that I'm looking for in Detroit, and y'all can look it up, Okay, there's some good commentary here, but
Yeah, funny.
but Wells Fargo is the biggest loan holder, right, in terms of mortgages. So, or they were. I don't know if they still are.
Yeah, I'm not
But
sure.
as we're moving forward through the process of purchasing or asking for a loan, the smaller banks are typically more agile, and what they end up doing anyway is they'll package the loan at a little bit of a higher interest rate, which is, and then they recoup their costs through closing costs and so forth. But by virtue of that, I ended up doing a 30-year loan. It's actually 4.75, not 4.0. I need to fix that number. So roughly, payments on that loan are 465. Not adding on some additional costs to that, which ultimately my loan is actually $777 moving forward. But also in Detroit, I have to pay for the water. The meter is not separated by tenant, so I have to pay the full meter of the water. But electric is covered by, and gas is covered by the tenants that pay. So random nuances, just heads up. Jake with the finger. The repairs are in there. I'm guesstimating it was going to be about 12K. Safety inspection also has to be done. This is part of that code
Nate,
enforcement in
when
Detroit.
you're buying a rental is there like a number for? Because I think some of these things you need to go in with somewhat of an expectation of like, because
Yeah,
when you all these costs are you need cash for these. These are not things you're paying in your loan, and so
yeah, yeah.
what do you use any formulas to come up with like how much repairs might be, like an estimate? Is it a percentage of the home cost or
Yeah,
different things like that?
there's kind of litmus tests, if you will, out there that 2% of the home cost, for example, or 5% of what you put. Like, there's random formulas out there. What I do is I don't have a traditional formula. What I look at is what am I putting in, and then I'll get into it here at the end. There's kind of this cap rate and some other things, but what am I putting in versus what am I going to get out? So I don't look at the overall cost of the property versus repairs that I need to do and do the math of rent and all that kind of stuff. I kind of do it a different way. And very good question though, and I'll explain that here in a minute once I run through the math here. But there is a bit of a cap. 12K on a purchase of 130 or $100,000 loan, for example, seems pretty high. But at the end of the day, for me, there's a few things playing in my favor here, I believe, right? So, 40K cash, 13K. So I put 33 cash and 13K for repair.
And then closing costs.
The closing costs were embedded into the down payment. Yeah, yeah,
Gotcha.
yeah. Good. But yeah, so let me see. So taxes, we were talking about this a little bit ago. It's actually, I think, a little above 1%. I was doing the calculation, the quick math on this. It's like 1.2% or something like that, which isn't extremely high, but it's on 130K, it's not that bad. And this is based on a spreadsheet that I need to update anyway. So when you're looking at taxes, and I break it down into monthly, common area expenses, and maintenance. So common area, actually, that's if you have commercial property predominantly, like areas that you can't really collect on, hallways and maintenance out in the yard and so forth. But for me in this regard, it's the water meter that I'm going to have to pay. It's between 100 and 150 a month. So I'm just going to play the worst case scenario, 150 a month, and then whatever I get in, back is a reward, I guess.
Another question,
PMI,
Nate.
yeah,
When you're putting in these potential costs, are you guessing the worst case scenario to like
absolutely, yeah.
base yourself? Okay.
Yeah, exactly. Because I don't want to think I'm getting the best thing and then go, what the heck just happened? I thought I was making X and now I'm making Y. And the discrepancy is so broad that it's hard for you to reconcile that in your brain while you're going through all this stuff. But yeah, I play very conservative in regards to what I'm going to gain out of the deal. And I played this like 4 different ways, like what if, right? And so vacancy rates, right? Theoretically, you put it 5% or 10%, whatever the number is you feel comfortable with. I feel very comfortable with the fact that I'm going to get somebody in the next 30 to 60 days. So I'm kind of discounting that in my head, not on paper, as we're moving forward. But PMI, as was alluded to, over 20%, don't need to worry about it. Maintenance, you always have to embed that into the costs of the property. So percentage wise, you could put something in there. I just put a hard cost of $50 where I feel comfortable. There's different formulas out there. I won't get too heavy into it. You can Google it. Property management company, they're taking 10% off the top. And so once again, these numbers aren't updated. This was like worst case scenario as I'm looking into this stuff. So that number is actually 700 is one tenant that's paying right now. I'm probably gonna have the other tenant pay around 900. So 1300 is 130. So 160 is like on the higher end. Like if I were to get X, this is what I'd be paying out. So kind of the comfort number, if you will, is about 1100. So assuming rent's 1600, cash per month is going to be $503 would be my cash flow coming in, which is the 1600 minus, this is best case scenario, remind you, as I fill vacancies and so forth, or worst case scenario, sorry, as I fill vacancy at $900 because I'm remodeling the one unit. So 503.60 comes back, cash per year, and you just kind of run the numbers. And so annual return is what I'm looking at when on my down payment. So how long, or what's the percentage that I'm getting back for the year on my down payment? And that's where I'm looking at the repairs and so forth. So that's where my number's coming from. People use a different formula, which I agree with, but it's a little different circumstance for me. I'd like to believe, just by virtue of the deal that was done here. It's under 100K. Like I'm not too stressed out. If this was a 400 plus K property, I'd be like, okay, I got to keep the means within this because my payments are going to be astronomically higher as I move forward. But I have wiggle room here. I feel comfortable, with what I've spent. If repairs were like 20 plus K, that's a whole different story at that point in time. And I would be charging more rent. So either your revenue increases or your costs decrease. And the only way to fix this is going to be revenue going up at some point. And then you have the cap rate. And this number is actually very important. This is one of the first numbers I look at when I'm looking at a property is what's the capitalization rate. So it's your expenses minus revenue divided by the original purchase price, typically is how you get to this number. And so you want it typically no less than 4%. That's like the bare minimum of what you're going to be receiving back on your investment. And so I like to stay between, if I can, get to 5 or 6%, which I will once I maximize my unit. That's going to increase, but currently I'm at 4.65% at this point in time. So as I'm running the numbers, there's constant flow going in and out. And then if I remodel, year over year, I can't, property values don't increase more than 2%. The other thing that I'm looking at in some of these investment areas, like in California, they're looking at rent control, a couple other things that might play into my opportunities to increase revenue or decrease costs. I can't really decrease my costs any more than where I'm at. So I have to increase the revenue, the rent. So if I am going to remodel or do something else to the unit, I'm going to definitely be increasing the rent. So that's why I'm not too worried about the upfront cost of the repairs. It's more like the ongoing maintenance. Plus, if I want to increase revenue, what's the next repair going to be? And I'm ballparking 5 to 6K if I want to do the other unit, because there's some items that I need to take care of there. The part of the scenario is the current tenant that lives there is actually kind of like the property manager on site, if you will, where the person takes care of the lawn, takes care of some of the quick fixes on the unit itself. So, from a mechanical standpoint, I got somebody that could do some quick things if needed. So I'm willing to keep the rent down up until, I need somebody else there or whatever it may be, but I don't have any intention of knocking anybody out. That's never my intent by any means. And so, and we kind of talked about this earlier too, Dill, where, I'm investing in a place that I believe in, both from a fundamental standpoint of a market, but also investing in a community. And so in this particular area of where I'm investing is a blue collar, heavy non-white community. Like, how can I have a great impact on a community where people earn their living, but also I'm investing in the opportunity of Detroit? And so we've talked about Ford, we've talked about GM, Quicken Loans or Rocket Mortgage is out there. So there's just a lot of things that are happening on the corporate side. And then there's government programming as well that they have lined up where you can buy auction homes that they have for sale to allow, they started $1,000 that you can rehab and fix up. So they have programming implemented into their current recovery, if you will, of Detroit, but it's not 1.8 million people like it was back in the 50s when the factories were performing 100%, right? Production and so forth. I mean, they're well under 1 million people now. And so trying to figure out what that next opportunity is, I think it's now. This is a 10, 20, 30-year plan for me, ultimately. And if at any point in time, what I've charged is to see where the opportunity lies. And I fundamentally believe this is a huge overlooked opportunity because Austin is lit up right now, California. Like everybody's so focused on the quick money that I think people are overlooking an opportunity. And so that's just kind of my 2 cents on that situation. Do you have any thoughts? Anybody in the chat? Very curious to hear what y'all think. And I know these numbers don't add up 100%, so don't judge me.
Well, I think like a couple things. So one thing that's really nice about, and here's what I'll say about Detroit. Nate and I specifically are looking, we've done research on what neighborhoods are looking the best, what areas. Those are important things when you're looking, especially if you're not living in a city. You really need to do your due diligence of where you're investing and why. Because if we think about Detroit specifically, there's areas of Detroit that are still
Mm-hmm.
way far away from being revitalized. But there's areas of Detroit that are already being revitalized and already, renovating properties that were had, boards on the windows for years. So I think
Right.
the biggest thing to call out here is really do your due diligence. And Nate and I have done that on specific areas of Detroit. And then another reason why we like Detroit is the home prices are really low. So we talked about things like San Jose. If you want to buy a rental property in San Jose, which I hope you're not, $700,000. What's 25% down on 700,000 compared to 25% down on a $130,000 property? So,
Yeah.
and this is a duplex, so it's 2 units. It's like two houses. So one house would
Yeah.
be, it's like 70,000 a house,
Yep.
and
Exactly.
so 65,000.
65.
But
Yep.
that's the reason why we're looking at these markets is we see an opportunity in an area where we think things are going to continue to develop, as well as it's a lower barrier of entry to buy a property. But we have done due diligence of what areas and why we're investing. But kind of like, and I think we can talk about it on future streams because it's a really important topic. But what's nice about buying a property that in an area that we believe is going to appreciate over time is as you build equity in that home and as it appreciates, you can take equity out to buy another rental property. So
Exactly.
you're obviously you're saving cash on the side because your day job is where you can hopefully make a little extra money if you're in that position, and then you're also making cash on the property every year, and your property is gaining in value. So you're finding ways to eventually buy more properties, which I think we can do another whole stream on that. But that's step two after you get your first property. But those are just a
Probably Ramos.
couple other things.
Um, so I'm gonna wrap it up here in a sec. I skipped over a piece just because it's part of the seller side of the market, but there's some liens. That's the other piece of this that I didn't know that the seller had, and so that's an important thing. Is the liens can actually prevent you from buying a property if they're not paid, but
Yeah.
because the proceeds of the sale went to pay off the debt, and the lien is something that the city, the county, any jurisdiction has over the property. That if it's not paid, it can be used against that property owner, specifically when trying to sell the deed to the property or whatever it may be. So, just running down really quick. This is my scenario. This is actually from my contract. Just heads up. Doesn't have my social security number, so we're good. But sale contract price was 130. The listing price was actually 125, and then they bumped it to 130. And I was like, I'm comfortable with 130, but I want a concession, a seller credit, and that was the 2,640 that you see here. Then there were some other credits that were applied, so I actually got 5,290 back applied to this itself. So originally the loan closing cost was 136. You can subtract out where's it at 33, so cash from to borrower, and then that puts me at about 100k or 97 at the end of the day after everything kind of sorts itself out. So part of that, I'm sure most of you have seen some of these documents before, but resources, just want to let folks know, I'm sure folks have seen Bigger Pockets. That's something. There's a bunch of YouTube channels, but Bigger Pockets, they have a
Great content.
podcast. fantastic content. They have a lot of material, a lot of opportunities for you to dive in and ask
They have free
questions.
accounts that you can sign up as well.
Right.
They have paid, but they also have free ones, and you can talk in the forums and ask questions. I think even for some of the free options. And then they also have a network of homes that are off-market homes that you can find in different area codes. It's not a lot of homes on there, but you can sometimes find off-market homes, which typically are a little bit cheaper than what you'd
Yeah.
find on Zillow.com or something.
Yeah. And locals important, Jake. I mean, the accessibility is
Yeah,
definitely something I've looked at, but in the state of California, I don't feel comfortable investing here for multiple reasons. But which is why I'm looking at other places. West Coast is kind of a hot market. I've looked in Washington, South Washington areas. Duplexes are like
Arizona.
400, 500K. Yeah. So my price point is like 250 or less for a duplex, and the rent has to make out what to make it all work out, right? Like you have to have the rent that could supply whatever it is that you're buying at. So yeah, many different avenues to look at, but this is something that I definitely like to invest my resources into, specifically when the market's not doing too well, or there's nothing to invest in. Quite frankly, sometimes where an opportunity like this comes up, and it's not even about the interest rates for me. It's like, is the price right? Is there a certain market that I'm looking at in long term? And this is definitely one of those. And so there's a lot of opportunity there. And then obviously we have our Discord. We added the real estate part there on the bottom. Dill posted this really good video about the housing market crashing, quote unquote. Could it
There's
crash?
more a
Who
video of
knows?
why it wouldn't,
Yeah,
but
exactly. Yeah, the
it was a
foreclosures tsunami,
Allegia with the title on that one. But
clickbait. But
yep.
very interesting stuff, and just keeping tabs on it because there's a lot of things happening simultaneously. But feel free. I'm curious to see where people are at. I know Rama, you're in the midst of something. Jake, you were talking about it. Charge, I don't know. Do you have anything? You pop in and out like always.
Charge is
So
like 16. I don't think he's getting
yeah,
properties
yeah,
for it
yeah,
yet.
exactly. But that's kind of where we're at in the grand scheme of things. I do have. Let me see if I can pop up. Yeah, I have. Let's see here. Oh man, you might have to take that part out. Might have had my social security up on that. Thought I had my other screen here.
I think it was
uh,
covered.
Maybe I'm gonna have to go back and see. But this is
Yeah,
the
check.
unit that I currently have. Um, this is one of
One
the
thing about
rooms.
Detroit, all the homes are super old. It's just what it is there. They
Yeah,
all
but
have
this.
they all have basements and cellars, and all your stuff is down there. And homes that are 80 years old potentially.
Yeah, and everything was pretty good in the basement. The furnaces, the water heaters were all up to go. Quick screenshot. Yeah, I know. So I was like, oh shit, that wasn't the right screen that was supposed to be up. But I couldn't swap out without going back anyway. Um, you can see newer windows on this side, not so newer windows here. The long-term rental. So this is also top floor, bottom floor duplex. So there's bottom floor unit and then the top floor, and the bottom unit is currently being renovated. You can see the guys setting up to do some work. Some of this has already been fixed, but kitchen area, gonna need to replace the door. Very superficial stuff, kind of easy fixes. Nothing too substantial, thankfully. Foundation doesn't have any problems. Bathroom, sorry if I'm clicking really fast. Yeah, grout kind of stuff here. Need to make sure that that window's sealed. That's always kind of a questionable move, is when you put a window by a shower, just because water damage and moisture. There might be increases the chances of some issues popping up. Paint. Some of these are the same photos. Bathroom, need to clean that out. This is a toilet that's going to be replaced. A few things here as well. The kitchen cabinetry is going to be replaced as well for that unit, but yeah, you can see it's
It's a little
not bad.
love.
Needs a little love. Stairs are cracking a little bit, but nothing too profound there. Got two
Someone
satellites
got their
under it.
Gatorade.
Exactly. But yeah, interesting unit. Nonetheless, they got a nice little balcony, so that part, no trespassing. They definitely don't want anybody walking through. But yeah, it's a good starter unit, definitely. And then parlay this into some bigger opportunities, I think, is we were talking about, pull some equity out of it, either through refi um, down the road, a year from now, remodel, get it appraised again, pull out whatever I can from that if I want to, and specifically if I want to start paying this down a little bit. But it's a cute little place. Yeah, real estate terms, it's cozy, as I would say. Nice and small, but it's cute. Yeah, I could take that. Yeah, it's just kind of like that bugs me a little bit, the discoloration between the two units.
It's funny.
But I'm not living there. Oh yeah, there's some videos that my agent
It's
did
not too
down in the
big of a
basement.
deal.
Yeah, just like a quick walkthrough that he did for me. But I mean, this is my agent going above and beyond. Like, it's once you find the right person, you can make it click. It's nice.
Chill on. Yeah.
Yeah, they had one in the kitchen, the ceiling, but I don't see it here. Yeah, so that's kind of where we're at. Very curious, as we move forward.
I think what Jake said is is a really great point. Is like, if you are in a market where you can start local, it's a great idea for a couple of reasons. Like, one, if you feel like you have the capacity to manage the property, you can save 10% of the rent potentially if you think you have that capacity. It's also where you're at, so it's easier to keep an eye on it. You don't have to really rely on
Exactly.
the
That's the
potential
problem I
property
had,
management company and
and
stuff like that.
that's the problem I had with the property I have in Washington. Is I was living in California at the time, still am, but up in Washington, I hired a property management company, and
Sometimes they suck.
praise word. The they had so that unit that I have is in an HOA and a homeowners association, and there were some violations that were persistent, and I got a letter in the mail. I was like, WTF, why is this happening? And then eventually it was like, all right, I got to boot them out because it wasn't being fixed, and I was the one in violation, not the tenant, based on the HOA, because I'm the owner of the property, so it's
Yeah.
up to me to fix it. So
And that brings up another point of like having your broker or realtor is really important, like someone that you can trust and that you vibe with that really knows what they're doing. And then also a property management company, because if you're not managing that property, you need to make sure somebody is really keeping a keen eye on that property and paying someone 7% versus 10%, but the 10% person is going to do 1,000 times better. It's worth the extra 3%. It's worth the extra couple hundred, $100 or something in extra costs. If they're really going to keep a close eye on the tenants and how the property's doing.
yep, exactly. Yeah, but it's yeah, that was a freaking nightmare. Probably.
And Nate will keep giving us updates on Detroit and how he's feeling about his first property there, if he still believes it's a great investment city. And
Yeah,
Nate's
it's
gonna be
already appreciated
the
$3,000.
Nate's gonna
The housing, that's not even including my. But nonetheless, yeah, very important point. But if y'all have any questions, please let us know. Definitely appreciate everybody's time here tonight. Keep us posted on your experiences too, because I know a few of you are going through some stuff as we speak as well. But
yeah, we want the obviously we're about the stock market and economy, but we do want to start bringing in more real estate content. One, because Nate and I are getting heavier in it, and we really think that if you're continuing to be successful in the market, this is a really great asset to transfer some of that money over into a more long-term asset like real estate. As Nate was saying, like, if you find a property in the right place, over the long term, it can do better than a standard real stock market investment, where your yields can be really a lot more consistent and or high. And so it's a great, if you're successful in the market, it's a great way to move that money over to a different asset.
exactly. Beautiful.
But I think that's a good place to end. I think thanks for covering all that, Nate. That was a lot of info. Definitely watch that back if you're here, if you're watching it on YouTube or later on Discord from Discord. I would say watch. This is a really good stream. We covered a lot of important concepts from the stock market perspective about market cycles. Really keeping a keen eye on the market cycles is going to be really important, because the market's in a really strange spot with the amount of debt that's being created in the system. And at some point, it's going to have a really big impact. So really keep an eye and get some of those diagrams, save those diagrams on your computer as images. And then we're going to continue to cover more topics on real estate, and we'll dive in even on some more intricacies of buying, whether it's a home for yourself or a rental property, and how to continue to buy more rental properties and how to leverage if you do buy a property, or even if you own a home, like you can even leverage that to buy a rental property. So we'll dive more into that
Exactly.
some of that stuff further.
I might be doing that soon with the home that I have in Washington. So I will keep y'all posted as well on that endeavor. Looking at bigger properties and bigger eyes on Detroit. So as we move forward. But thank y'all for hopping in with us. Greatly appreciate you.
Appreciate you guys as always.
Where we play
and you win.
Beautiful. Thank y'all.